What if the biggest financial mistake you ever made was not a bad investment, a failed business, or a reckless decision you can point to and explain? What if it was something quieter than that, something you did slowly, incrementally, over years, without ever realizing the cost was compounding in the background? That is the financial reality facing millions of people over 40 right now. Not the dramatic losses, not the headlines, just the slow, silent erosion of what could have been, and the growing weight of a retirement timeline that no longer feels like a distant horizon. It feels like a closing window. If you have found yourself at a point in your life where you have worked hard, earned reasonably well, made decisions that seemed logical at the time, and yet you are staring at a retirement calculator that is telling a story you are not ready to accept, you are not alone. And more importantly, you are not too late. This video is built for exactly where you are right now. By the time it ends, you will understand with precision and clarity what the number one money regret is across the 40-plus demographic, why it carries the weight it does, and most critically, the exact framework to reverse it from this moment forward. You will walk away with a concrete action you can take this week that begins the compounding recovery immediately. Stay until the final lesson. The most important insight in this entire video is not in the first 5 minutes. It is the one most people never act on. And the reason will become clear only once you understand the full architecture of the problem. Before we go further, take a moment and think about the people in your life who depend on the financial decisions you make over the next 10 years. Your partner, your children, the version of yourself you want to be at 65. The weight of those relationships is exactly what this channel exists to serve. If you are not subscribed, do that now. Not for an algorithm, but as a declaration to yourself that you are committed to building the second half of your financial life with intentionality. Every video on this channel is a strategic asset for that journey. Now, I want to ask you 3 questions, and I want you to answer honestly in the comments below. At what age did you seriously start thinking about retirement? Drop your number in the comments. Have you ever watched a raise or a bonus disappear into lifestyle rather than wealth? Tell me about it below. And what is the one financial decision you wish you had made 10 years earlier? I read every single comment. We are operating in an economic environment in 2026 that has fundamentally redefined the rules for the over 40 investor. The financial playbook that worked for the generation before us, contribute to your pension, own your home, retire at 65, live off the interest, has been systematically dismantled by forces that were not present 20 years ago. Persistent inflation has eroded the purchasing power of savings accounts so comprehensively that money sitting in a standard deposit account is, in real terms, losing value every single month. The compounding velocity of an uninvested cash position is now negative. That is not a metaphor. It is arithmetic. At the same time, the defined benefit pension, the employer-sponsored retirement income guarantee that your parents may have relied upon, covers a fraction of today's workforce. The burden of retirement architecture has shifted almost entirely onto the individual. What this means for someone over 40 who has not yet built a diversified investment portfolio is stark. There is no safety net being constructed on your behalf. Fiscal longevity is now a personal responsibility, not an institutional one. And then there is the longevity factor. Actuarial data now projects that a 45-year-old in reasonable health will likely live into their late 80s. That is not a 20-year retirement. That is potentially a 40-year retirement. The traditional savings model was never designed to sustain 4 decades of post-employment living. Without compounding investment growth, it cannot. Meanwhile, the asset vehicles available to the over 40 investor in 2026 represent an unprecedented opportunity. Index funds, REITs, dividend-yielding equity portfolios and structured passive income streams offer inflationary hedges and compounding mechanisms that previous generations simply did not have access to at this scale or at this cost. The brutal truth is this: the old rules have not just changed, they have reversed. The financial behaviors that were adequate 20 years ago are now structurally insufficient. But here is what that means for someone who is paying attention right now. The gap between the majority who do not adjust and the minority who do is going to be the defining financial divide of the next 2 decades. Understanding that divide, and which side of it you end up on, begins with understanding the number one regret. And it begins with understanding it honestly. Chapter 1: The Anatomy of Financial Regret After 40. Financial regret after 40 is rarely born from catastrophe. It is born from accumulation, the compounding of small, reasonable, thoroughly logical decisions that collectively produce an unreasonable outcome. The number one money regret, confirmed consistently across behavioral finance research, financial planning surveys, and the quiet confessions people make when the numbers are finally honest with them, is not a wrong investment. It is not a lifestyle excess. It is starting too late. Starting late with retirement contributions. Starting late with investment architecture. Starting late with passive income. Starting late with the fundamental shift in thinking from earning money to making money work. Think of it this way: every year of delayed investment action is not just a missed year. It is a year in which compounding was not working, a year in which your money was not generating compounding velocity. It was stagnant, and stagnant capital in an inflationary environment is not neutral. It is retreating. The anatomy of regret is, at its core, the anatomy of compounding running in reverse. The reason this matters as a diagnostic tool rather than simply an emotional weight is this: once you understand precisely where the delay occurred, where capital sat idle, where income was consumed rather than invested, where the structural decisions were deferred, you can calculate with precision where the recovery must focus. Regret becomes a financial map rather than a feeling. Chapter 2: The Starting Late Penalty, and How to Reverse It. There is a number that circulates in financial education that is technically accurate, but psychologically devastating if applied without context. That number is the difference in outcome between investing at 25 versus investing at 40. At identical contribution rates, the 25-year-old will accumulate significantly more because time in the market is the most powerful compounding lever that exists. That is true, but here is what that framing consistently omits. The 40-year-old investor is not the same entity as the 25-year-old investor with less time. They are a categorically different financial actor with categorically different advantages. The over 40 investor, in most cases, has peak or near peak earning capacity. They have resolved the expensive lifestyle experimentation of their 20s and 30s. They have a clarity about risk tolerance and investment behavior that was impossible at 25. They have professional networks that create passive income opportunities, consulting, advisory roles, equity participation that younger investors cannot access. And they have the emotional maturity to hold through volatility rather than panic selling at the worst possible moment. The path to reversing the starting late penalty is not reckless acceleration. It is deliberate intensification, higher contribution rates, enabled by peak earnings, a cleaner portfolio structure, diversified but not diluted, aggressive but not speculative, and critically, a longer view than most people at 40 allow themselves to take. The investor who tells themselves the story is already over is the only investor for whom that story is true. Pause for a moment here, because what we just covered, the difference between the starting late penalty and the starting late advantage, is the reframe that most people never receive. If you have ever opened a retirement calculator, looked at the projected number, and quietly closed it because the gap felt too big to confront, type yes in the comments right now. You are not alone in that moment. That feeling is almost universal in this demographic. And it is also the precise moment when most people make the most costly decision of their financial second half. They decide that the direction cannot change, so they stop trying to change it. That decision, the decision to stop, is the actual financial crisis, not the gap, the giving up on closing it. Everything that follows in this video is built to make sure you never make that decision. Now let us continue. Chapter 3. The 3 decisions that generate the most regret. Behavioral finance research is remarkably consistent when it comes to identifying the specific decision patterns that generate the deepest, most persistent, long-term financial regret for the over 40 demographic. 3 decisions dominate. The first is prioritizing home equity over investment portfolio growth. For an entire generation, home ownership was positioned as the primary wealth vehicle, the sensible, stable, respectable path to financial security. And while property ownership has genuine value, it has one critical structural flaw that a generation of homeowners has been slow to confront. Equity locked in a primary residence cannot generate income. It is an illiquid store of value that does not compound in the way an invested portfolio does. The individual who directed 30% of their income into mortgage overpayments for 15 years while contributing minimally to a pension or investment account has wealth on paper and poverty in cash flow. At 60, that is a structural problem that is expensive to solve. The second is lifestyle creep that consumed every raise before it could compound. This is perhaps the most socially normalized form of financial self-sabotage available. Every promotion, every salary increase, every bonus absorbed smoothly into a more expensive car, a better holiday, a larger home, a private school. The performance of success instead of the quiet engineering of it. The compound cost of lifestyle creep is not the money spent. It is the compounding that money never got to do. The third is the failure to build multiple income streams, depending entirely on a single employer, a single salary. And a single point of failure is not a conservative financial strategy. It is a maximally leveraged bet on one variable remaining stable indefinitely. At 50, that bet becomes increasingly precarious. Redundancy, sector disruption, health challenges, organizational restructuring. Any one of these can eliminate the single income stream that an entire financial life is balanced upon. The construction of passive income, dividends, rental income, digital assets, consulting revenue is not a luxury enhancement to a solid financial plan. It is the structural redundancy that the plan cannot function safely without. Chapter 4. The Redemption Framework. Regret, properly channeled, is one of the most powerful financial motivators available. The problem is that most people do not channel it. They carry it. And carried regret produces paralysis, not action. The redemption framework moves it from a weight into a tool in 3 precise phases. Phase 1 is honest diagnosis, a clear-eyed, shame-free assessment of where the actual gaps are. Not the story you tell yourself about the gaps, the numbers. Where is capital sitting uninvested? What is the actual pension projection? What would the income shortfall be at 65 based on current trajectory? Diagnosis without distortion is the only productive starting point. Phase 2 is strategic compression, identifying the highest leverage financial moves available right now, the actions that recover the most ground in the least time. For most people in this demographic, this means 3 things: maximizing pension contributions to capture all available tax relief, establishing an automated monthly investment into a low-cost index fund structure, and identifying the first passive income stream that can be architected within the next 12 months using existing professional skills and networks. Phase 3 is structural commitment, automating and simplifying the recovery so that it happens consistently, not only in motivated moments. The most sophisticated financial recovery plan in the world is worth nothing if it requires daily willpower to maintain. Automation removes willpower from the equation. What is automated compounds. What depends on motivation eventually does not. Chapter 5. The Compound Recovery Window. Here is the perspective shift that changes everything. The 20-year window between 40 and 60 is not a consolation prize for starting late. It is a distinct and extraordinarily powerful financial season, one that, approached correctly, can produce outcomes that genuinely rival the compounding advantage of starting earlier. Peak earnings, lower child-rearing costs as children mature into adulthood, mortgage equity that can be strategically leveraged, professional networks that open passive income channels unavailable to younger investors, the emotional capital of lived experience that makes it possible to hold course through market volatility. These are not minor compensations. They are serious structural advantages that a well-constructed strategy can exploit with remarkable effectiveness. The investor who begins a disciplined, high-contribution investment program at 42 and holds it with consistency for 20 years is not the tragic character in the story of wealth building. They are, in many cases, the most effective one, because they bring everything that 25-year-old discipline cannot: clarity, earnings power, and the irreplaceable understanding that time is not infinite. That understanding, properly mobilized, is the most powerful investment accelerant available. Now we arrive at the insight that almost nobody acts on, despite knowing it intellectually. This is the highest value lesson in this entire video. The single highest impact action available to someone over 40 who feels behind is not a dramatic portfolio restructure. It is not selling the house, pivoting the career, or finding a high-risk investment that promises to close the gap in 18 months. Those paths are built on panic, not strategy, and panic compounds losses, not gains. The action is this: establish one automated monthly investment contribution, however modest, into a low-cost, diversified index fund or pension vehicle beginning this week. Not next month, when the budget is clearer. Not next year, when the mortgage rate changes. This week, the amount is almost irrelevant at this stage. What matters is not the size of the contribution. It is the psychological and structural shift that the contribution represents. The moment you automate that transfer, something changes in the financial subconscious. The direction has changed, and direction, compounded consistently over 20 years, is everything. Regret loses its power the moment action begins. Not the moment the plan is perfect, not the moment the portfolio is optimized. The moment action begins. That is the intervention point that separates the over 40 investor who recovers from the one who does not. One act, this week, automated, repeated, the rest follows. That is not a motivational statement. It is a compounding mechanism, and it works precisely because it removes the decision from the equation. Set it, forget it, let it compound. That is fiscal longevity, built one automated transfer at a time. You came into this video carrying a weight that most people in your position carry silently. The weight of time that passed while the compounding clock was running. The quiet regret of decisions that seemed reasonable and turned out to be costly. You have now seen that weight for what it actually is, not a verdict on your past, but a diagnostic tool for your future. Late is not the same as too late. The window between now and 60 is more powerful than most people in this demographic are ever told. The framework is clear. The action is simple. The only variable is whether you take it. Take this video and share it with one person over 40 who needs to hear it, someone who is brilliant at their career and behind on their wealth. They will not thank you immediately. They will thank you in 10 years. Subscribe to this channel as a long-term commitment to your financial second act. Every video here is a building block for the wealth architecture you are now constructing. And when you are ready for the next step, Watch this. Why your home is not your retirement plan. The asset trap millions of people over 40 are still in. It picks up exactly where this video ends. Your time is your most valuable asset. You invested some of it here, today. Make sure the rest of it compounds.